Hi, I'm Kevin Walton with C2 Reverse. I've been doing reverse mortgages for 10 years and I've come across some people who are actually scared of reverse mortgages. Even though this loan could possibly improve their quality of life, they're scared. They have heard bad things about the loan and will not consider it as an option. They've either read articles on the internet, heard from friends and relatives that the reverse mortgage is not a good loan. It's dangerous. Their fears are real. The reverse mortgage loan was not a good loan for a long time. I'm not here to say the reverse mortgage is for everyone over the age of 55 because it's not. It may not fit family dynamics in certain situations. But once you understand the concept of how reverse mortgages work and are aware of the recent guideline changes, it may help clear some misconceptions. I'm going to go over 3 changes to the HECM reverse mortgage implemented in 2016 that most people may not be aware of, and hopefully it might subside some angst that people may have about the loan. I'll also go over a few other protections the reverse mortgage process has built into the loan that people may also not be aware of. Reverse mortgages have been around since the early 60s, and it was not a good loan, as I said, for a very long time. People now entering retirement years remember how bad this loan used to be, and that first impression has stuck. With some versions of the reverse mortgage, borrowers had to actually sign over their house to the bank, and when it came time the house was sold, the bank got to keep the equity profit, not you or your heirs. That's just not okay. People remember this. This is not the case any longer. Any equity from the sale of the home goes to you or your heirs, just like a regular conventional loan situation. It's been this way for quite some time, but that lingering memory is still there. Other reverse mortgage versions that used to be around had the borrower take out a life annuity as part of the loan to make sure that when it came time to sell the home, and if you owed more than the property value, the annuity would pay the gap. The annuity was extremely expensive and protected the bank, not the borrower. Again, people today remember that too. Again, just not good. The government finally had to get involved and regulate the loan to protect senior citizens. So in 1988, President Reagan signed the HECM reverse mortgage into law so it had federal oversight, as it does now. And since the loan had gone through several major changes, adding more protections along the way. The government-insured version of the reverse mortgage is the Home Equity Conversion Mortgage, or HECM, H-E-C-M for short. And it is in the family of FHA loans. Being an FHA loan, MIP insurance is required on the HECM loan to protect the lender in the event at the time of paying off the loan or selling the home. If the property is upside down, the insurance pays the gap, not the borrower or your heirs. Reverse mortgages are a non-recourse loan, which means the lender can't come after you for the difference. But there are still problems plaguing the HECM reverse mortgage, and more changes and protections were needed. So in 2016, the HECM implemented the following protections and guidelines. But many people, again, aren't aware of these updates. The 3 issues are where I'm finding the majority of fear exists are the following. Lender foreclosing on reverse mortgage borrowers due to not paying property taxes. Some elderly people with reverse mortgages were losing their homes to foreclosure due to non-payment of property taxes. Property taxes are the senior lien in the land. If a homeowner doesn't pay their property tax bill, the county tax collector can foreclose and keep the profit from the sale. If there is a loan on the property, like a reverse mortgage or a regular conventional loan mortgage, the lenders lose their entire balance. The tax collector doesn't have to give them a dime. This, of course, freaks out lenders. So there were times when they raced to foreclosure not knowing what the tax collector was going to do. So they had to protect their interest. To fix this, now on new reverse mortgages going forward from 2016, A financial assessment calculation is required to be done for all reverse mortgages. Reverse mortgage applicants must demonstrate they have the funds and willingness to pay their property taxes and home insurance in a timely manner. There is a 2-year payment history that must show payments were made on time. If the homeowner has been late on either of these things without an acceptable excuse, the lender will do an algorithm on the reverse mortgage applicant's expected lifespan and then collect that number of years worth of property taxes and or homeowner's insurance and include that number into the reverse mortgage loan. And when property taxes come due, the lender pays it. It's not an impound account. An impound account, a borrower makes monthly payments and contributes to the impound account. A reverse mortgage doesn't require any monthly mortgage payments, which is why a number of years are collected up front and rolled into the loan amount. If there isn't enough room in the loan to accommodate this figure, the loan may possibly be declined. This practice has drastically slowed down the foreclosure issue related to non-payment of property taxes and insurance on the reverse mortgage. But also know that lenders, even on conventional loans that aren't reverse mortgages, this concept is the same. Lenders can lose their balance if the county forecloses on the property and the lender loses their balance. So it's not just reverse mortgages that face this issue. The second thing I've come across is the fear that people run out of money too quickly. So the reverse mortgage put into place a guideline to fix that. So now the reverse mortgage borrower is now limited to the amount of funds they can take out or withdraw during the first year on a HECM line of credit loan. Case studies showed that some reverse mortgages, the borrowers were using up all their available funds in the first year, not having any funds to use for their future or have funds to pay their property taxes. So a cap of 60% of the loan amount, the HECM loan amount, can be drawn from the line of credit option the first year, 60%, with the balance being available starting the second year. This has helped more reverse mortgage borrowers keep more of their money in the line of credit for a longer period of time. The third thing that has caused a lot of bad press on the reverse mortgage industry is spouses less than the age of 62 were not allowed to stay in the property if the older spouse passed away. Again, not okay. At the time of the reverse mortgage loan application, all borrowers that would be going on the loan had to be 62 years of age. But what if we had one spouse who was 70 and the other was 59? What then? Since the minimum age for a HECM reverse mortgage is 62, and there was someone else on title who couldn't go on the loan due to not satisfying the minimum age requirement, if the older spouse passed away, the younger spouse had to pay the loan off or sell the home. Again, that's really bad. However, now, from 2016 and forward, as long as the HECM lender is advised by the borrower that there is a spouse younger than 62 at the time of the application, and if tragically the older spouse passes away, the younger spouse can now stay in the property as long as they live in the property as their owner-occupied residence, and they don't have to make any monthly mortgage payments either, with the understanding that they do not get access to any remaining reverse mortgage funds that may be in the line of credit. There are a few other things that you may not know that may make you feel at ease with the reverse mortgage process. For one, there is required reverse mortgage counseling for each reverse mortgage loan that must be done prior to a loan application being taken. And in some states like California, there's an additional 7-day cool-off period after counseling to give the applicant time to ask questions before being able to move forward with a loan application. The cool-off is meant to slow the process down and allow the borrower time to absorb the information being presented to them. The loan officer may not be on the counseling call either. The counselor goes over the reverse mortgage proposal that was sent to them by the lender to make sure they understand how the loan works. Friends, relatives, and financial people can also be on that call as well. I like to make videos for my clients that are unique to their situation. I show amortization tables and go over guidelines. The video can be forwarded to loved ones or financial people. I have found this helps tremendously. All my clients know exactly how this loan works, and I also discuss with them the process of how things work after they pass away. That's also important. It's also important to note the non-HECM reverse mortgages, which are now available, have a different set of rules. For example, their minimum age is 55 years, not 62 like the HECM. And if there is a younger spouse who doesn't meet the minimum age requirement to go on the loan, they may not be able to stay in the property if the older spouse passes away. Also, there is no limitation on how much money they can draw from the line of credit their first year, like the HECM. I go over both types of loans in my video with the side-by-side comparison so people can see the differences in these loans. The recent guideline changes have made the HECM reverse mortgage more user-friendly and safer, but the issue is that the general public doesn't know about these changes. It's hard to know if the articles you're reading on the internet were written prior to 2016 or not. Older loans on the books prior to 2016 are based on rules on what they were at the time that loan was done. So, we will still hear some lingering problems from older loans done prior to 2016. The easy answer is that everyone with an older reverse mortgage refinance the most recent HECM reverse mortgage. But for some, it's impossible. If they've used up all their funds, combine that with a rising mortgage balance due to not making mortgage payments, and if property values have dipped in their area, all these factors combined wouldn't give enough equity to refinance to the new loan and updated protections. They would be short funds to refinance their current reverse mortgage. Financial pundits on the radio and internet are not aware of these added protections either. Many recent videos I've seen on YouTube do not highlight any of the reverse mortgage loan updates. They tend to concentrate on older loan issues. Although very real, many of these issues have been dealt with for new loans going forward, and that needs to be communicated to the public. If you were afraid of reverse mortgages before watching this video, hopefully I've addressed some of your fears. Reverse mortgages may not be for everybody, but for those who need and understand how the loan works, it can be a game changer in improving their overall quality of daily life. Feel free to fill out the contact form, on my website with your situation, and I can make a video for you, and if you like, I'll make it unique to your situation. A reverse mortgage may make sense for you, but if it doesn't, I will tell you that too. Again, thanks for watching.